Hi everyone, this is Anton Mattli with Peak Market Watch. I'm here with my colleague John Martinez, and today we have a special guest, Matt Picheny. Matt, welcome to be on with us today. Matt has a very unique background, so rather than me telling everyone what your background is, why don't you tell us where you started and where you are today?
Certainly. Thanks for having me on the show. I appreciate it. Yeah, I do have a bit of a unique background. I grew up in Florida and moved to New York City to pursue a career as an actor. So I think that's maybe something a little different than most of the guests that you have on the show. And I was a professional actor for 5 years, performed in 15 different productions throughout the United States. Started tinkering around with computers. And so I'm talking like the mid to late 90s, and started doing a lot of work in between acting gigs in the computer world, and ended up having so much work, because this was during the big .com boom, that I actually ended up starting my own boutique agency, doing website development. I ran that for about 5 years, because 2001 came along and the .com bubble burst and my business was imploding. All my clients were going out of business. The ones that were staying in business were not spending any money on digital marketing. And it just so happened that at that time, I got a phone call from my landlord, and he told me I had 90 days to get out of the apartment that I was living in. So that was an unpleasant time. And I wanted to stay in New York because I loved living in New York City, but how was I going to find a new place to live without really a job, with a business that has completely failed? I ended up getting a job at Showtime, the cable television channel. They were a client of mine. They offered me a position in-house, and I was looking for a place to rent, and I found an apartment that was actually for sale. Not where I necessarily wanted to live. It was still in Manhattan, but it was upper Manhattan, up in an area called Washington Heights, which was quite a commute to get back down to where work was and where all my friends were. But it was definitely affordable. And I bought an apartment, and then I sold it a little over 2 years later. And I saw my initial investment, my down payment in that property, more than quadruple in value. So that was a big light bulb moment for me. How do I do that again? At that point, I was working full time. I had a very good job and a very good salary, but that one real estate transaction was actually more than an entire year's worth of salary for me. So, but I wanted to figure out how to do that again. And that's what set me on the path, to where I am now. I did a bunch of different things in real estate. I did it as a hobby for about 10 years after that. A couple of years after that transaction, I bought my first investment property, which was a vacation rental. And then I ended up doing some fix and flips. And, there's a couple of different things that I did. But about 7 years ago, I found real estate syndication. And that was right around the time that I had decided to do real estate full time. And that's where I've been ever since, just working on real estate syndications. I'm a full-time investor now. I've invested in over 10,000 apartment units across the country. Now, over 7,000 of those are deals that I'm a passive investor in, limited partner, right? This is all fractional ownership. It's not like I own all 10,000 units, right? But I've invested passively in a lot of people's deals. And then I have almost 4,000 units that I'm a general partner on. So that's me. I'm a full-time real estate investor. I'm also a Tony Award winner, which we can get into, that not from my acting days, but actually producing some Broadway stuff, co-producing along with my wife. And I've also written a #1 best-selling book called Backstage Guide to Real Estate. So that's kind of the nutshell intro for me.
Very good. So obviously very unique, right? How you ended up on the real estate side, not uncommon, right? Where someone has a in life you have that light bulb moment, and then you realize, oh, that's actually a good thing to do, right? And obviously it happened to you also kind of out of an accident, and which is even cooler, right? Now, you mentioned, right, you with your wife, you're also active on not just, you were not just an actor, but you're now also active on the Broadway show side as a co-producer on some, and as an investor in others. So maybe you can tell us a little bit more about that, and how that compares to real estate investing.
Sure. Having that background as an actor, something that I'm always been interested in and passionate about is the arts. That's actually one of the first things that attracted me to my wife. Besides the fact that she's beautiful, but when we first met, we were talking, and I found out that she was in the arts and that she was passionate about the arts, ability to impact people's lives and positively, right, and help sort of bolster change. And I found that amazing, and the way that I felt too. And so we were sort of kindred spirits, if you will, from that perspective. And so I've always been very interested in the arts, and just a big fan of theater and music and even visual art, right? I met my wife, Erica, and Erica had already produced a Broadway show, and she works on the business side of Broadway. That's her full-time thing. My full-time thing is real estate. But once in a while, we will join forces together and get involved in some shows. We've invested as passive investors in a couple of shows. The most notable, now they're not all this good, but the most notable one is Hamilton, right? So we invested in Hamilton. We were fortunate that one did as well as it did. It's an amazing show. And we also have gotten more involved and with some shows as co-producers. So we were co-producers on Moulin Rouge, which is still running on Broadway right now. And a show called American Utopia. It was a David Byrne show that was a limited engagement, ran a couple of times. So we've done that. We have a couple of shows that we have that are in various stages of development, right? So these shows don't just go right to Broadway. They start off as an idea in someone's head, and they put pen to paper, or I actually probably not so much anymore today. They type it, but they put down their thoughts, and then, if someone sees promise in something like we have, we then try to figure out ways to get the work done. And it goes through a development process, and there's many different iterations before a show actually ends up on Broadway. So, in terms of the investments and like, how do the investments work, which is what most of your, people might be interested in, because I know just about everyone who's listening to this is an investor. It's really interesting. So I went to an event, and it was a thing. It was like all about syndication, right? It was a seminar. It was a live seminar in Texas. And I went there to learn about syndication. And because I had heard about syndication, but I didn't know what it was. Now, we had already done some Broadway show investing, but I'd never set up like a real estate syndication. I went to a webinar or seminar, and I called my wife the first night, and I'm like, it's just like the Broadway shows. Like, I was surprised. We had always done, like there's a PPM, right? And the subscription documents and the operating agreement, right? All of those things are there for Broadway shows. I just didn't know that was like a thing that other people did in other things, right? And then I was like, oh, now I understand why there's like this reference to this 506C thing. I didn't quite understand that it was an SEC regulation, and we were accredited investors, so we were able to invest in these shows, but I had no idea. So basically, most Broadway shows are set up like a 506C syndication, and then you're a passive investor in the deal, and then the producers are really act as sort of the sponsors of the deal, right? I'm equating this to a real estate syndication. And then you have, in real estate, you have a property manager that really makes sure things are working on the day-to-day. So in Broadway, there's a general manager, and the general manager is the one who's there making sure that things are running from the day-to-day perspective. And then, hopefully the show goes well. When we look at real estate, I primarily in multifamily, really in any version of real estate, there's some sort of occupancy, right? And at a theater, there's occupancy. And at a theater, there's a price for the ticket, which we might equate to rent. So if your show is not doing well, maybe you discount your tickets, which we do with rent. Sometimes we discount our rent, or we do concessions on our rent, right? So there's a bunch of like parallels that you can draw between the two. But hopefully, if the team who's putting the Broadway show together has done a good job, and they've figured out the numbers accurately, then if your occupancy is at a certain level for a certain amount of time and you're not giving too much concessions away, then hopefully you would have a profitable venture. The thing that's different between the real estate and the Broadway show is, with real estate, you have an asset that you're holding on to, and the operations are giving you some money. But a lot of times where the majority of the money is made is when you actually go ahead and dispose of the asset, right? Go ahead and sell it and exit the deal. With Broadway, you're making the money while the show's running, and then the show stops and it's over. There's no like asset to sell. The thing that is interesting is that that show that you've invested in may have a life beyond the Broadway run. When you think of shows like Cats or Annie or Grease, right? I'm just talking about some really popular, especially when we talk about like Annie or Grease. Those are shows that ran on Broadway, had a great life, ended, but then have been done in regional theaters and high schools and just community theaters like across the country for years. Now, eventually you run out, but for a certain amount of time after that Broadway production, you still have subsidiary rights. So you're still getting residual income from those. It's a small amount, but if you have a show that like every high school in America is doing, it could end up being a lot. Those little amounts add up. And then the other thing I should note is that if you invest in the original Broadway production, you usually have the rights to invest in subsequent, like other productions, like as an example for Moulin Rouge, there's the Broadway production. There's also a US tour. There's also a production in the UK. There's also a production in Australia. So as producers, we're involved in all of those, and all of our investors have the ability to, almost all of them are involved in every single one of those productions. So that's kind of cool, but it's a little bit different. And then the last thing that I'll say, the biggest difference is the risk reward factor. 80% of Broadway shows do not recoup their initial investment. So that's why we only want accredited investors to invest in these deals, and people that have that risk tolerance to understand that they may lose the entire, like, I don't know that many people who've lost their entire investment in a real estate deal. Some have, but sometimes there's a loss, but it's not like a complete loss. Broadway, that is a possibility. However, the reward can be insanely high. So if you treat it, and what I say to people is, look, if you treat this more like a mutual fund, or like a portfolio, if you will, like say that you really like the theater, you really love the arts, you really love Broadway, and you want to invest in it because you're passionate about it, you care about it. And maybe you say to yourself, okay, I'm willing to invest $100,000 in Broadway shows over the next certain period of time. And then you invest $25K in one, and then you wait, and then you invest $25K in another, or maybe it's $50K in one, $50K in another. But I guess what I'm saying is I would say to people, if you spread your bets out a little bit, that will probably help, because no matter how good the underwriting is on the deal, there's a certain subjective thing, like whether people like the show or not. And some of that's beyond your control. You might love the show, but the general public doesn't buy tickets, so you can't control that.
Yeah, definitely. So I would say it's probably getting closer to oil and gas investments, right? Where you also have a high failure rate, but if you hit a good producing well, then it's great. And it's the same principle. You need to spread the risk, right? If you just go for one, the chances or the risk that you're actually losing 100% of your investment is pretty big. But if you invest in 10 drillings, then the chances are pretty good that one that is really out of the world performance can recover all the losses you may have on the others. Right?
So Matt, a question for you real quick. I apologize to step in, Anton, but you had a prior background before coming into multifamily, or with risk reward from all those experiences. Now that you're still passive, now you're a syndicator, you're working with passive investors who maybe don't have that type of background in essentially analyzing and assessing risk. What are some of the things you tell them to kind of help them understand either how they get comfortable with their own level of risk, how they think about something maybe you're presenting to them? Because I think that's something, in our audience, we both have syndicate passive as well as active investors. I think some of those passives, maybe it's a little bit a bit of a leap of faith, but how do you work with them? What do you tell them? Like, how do you get them comfortable?
Sure. So education, first and foremost, is the most important thing. The reason why I wrote my book, and sorry, this might sound like a shameless plug, but I mean, I wrote the book for passive investors to sort of understand things. Now, what I will say is, if you go onto my website, which I'm sure we'll do a link in the notes to talk about it at the end, I have a free resource there, which is part of the book, right? And so it's called Quickly Sizing Up a Syndication. So it's not as in-depth as it is in the book, but it gives a cursory idea. And basically what I talk about is three things that I want to look at, what I call the three deal pillars, which is the sponsor, the market, and then the deal itself. So, when we're looking at the sponsor, we want to understand who's that person, how do we know them, how have we met them? If John, if you've introduced me to someone and you say, hey, I've invested with them before and it went really well, then that bodes very well. If I get some random Facebook message from some guy, go say, yeah, I'm going to 10x your money in 2 weeks, send me your money now, then I'm like, okay, that seems a little weird, right? So those are some of the things I want to know, like who they are, what's their track record. But definitely if there's that sort of like firsthand introduction kind of, or someone can sort of vouch for another person, that's awesome. It doesn't always happen. Most of the investments that I've done were not done that way initially. Now some of them are, because I've just been doing this for so long. But so that's number one. Then the market. How do you feel about that particular market? And then what's the third party data telling you about that market? If population growth is going down and everyone seems to be leaving that area, then maybe that's not a good area. And you got to look at. People talk about Dallas, how great Dallas is. And I'm picking on Dallas because I've invested a lot in Dallas and I'm very happy with Dallas. So I'm not saying Dallas isn't good, but Dallas is a very, very large MSA, right? When you look at Dallas, Fort Worth MSA, it's like huge. So then what's the sub-market that you are within there? Start narrowing it down. And then even within the sub-market, like, what's the 1 mile radius look like around there? What's the 1, 3, and 5 mile radius? What does that look like for, population growth and household income and things like that? I mean, look, I live in New York City, and I'll tell you, the place that I moved into right next door is actually, I talk about it in the book because it's a funny story and a scary story, but funny. But right next door, there was a abandoned KFC that was like breeding mosquitoes by the truckloads. Like, it was bad when I first moved in here, but I knew it was on the path of progress, right? Now there is a gorgeous luxury high-rise. I mean, studio apartment is, don't quote me on this, but I think it's like around $1 million for like a studio or 1 bedroom. A lot of the units are going for $3, $4, $5 million, right? That's adjacent to my property. And now right at the other end of the block, there is a low income housing project, right? So real estate, there's that old joke about, what are the three most important things in real estate? Location, 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 right? So location's really important. So that's the market that I'm talking about, right? Looking big and then drilling in. And then the other thing is the deal itself, right? What are the metrics on the deal? What are they projecting for rent growth? What are they projecting for the exit cap rate? These things can really change the numbers that you're going to have, even a small change on those. So what is the person who's putting the deal together? What are they basing their assumptions on? If they're basing them on current market data or the way things have been going for the past 12 months, maybe that's not necessarily the best. I mean, I don't know, the last 12 months haven't been so great lately, but 12 months ago, if they had been basing it on the previous 12 months, right, that maybe was not the greatest thing. But like what I try to do and what I recommend to people is like try to get an understanding historically of what those numbers look like. What does historical rent growth look like? Okay, great. I understand it's been growing by 12% every year for the past year or two, but like historically, this market is like a 2% rent growth. What's the historical cap rate? Because cap rates were really, really low. They've been coming up, as we all know, right? And as that rate goes up, it means values are going down. I've been underwriting towards more historical cap rates. And I think a lot of people thought I was crazy and I lost a lot of deals because I was probably being too conservative. But now I'm like, okay, well, I can, sort of breathe a sigh of relief on, these exit cap rates, because even though cap rates are climbing up, they're still not where I had projected for our exit. So we're in good shape. But those are the kinds of things that you really need to sort of understand and peer under the hood. And so what I try to do in that free download and also in the book is kind of peel back the curtain a little bit so that people can sort of understand what's going on with those metrics. And that's the education that I think people need to have, just a little bit of education so that they can understand what's driving those numbers. Because I might have a deal that's at 80% return, and I'll pick on Anton now. Anton has a deal that's 100% return. And so Anton's deal sounds better, but then you look at it and Anton's, bringing the cap rate down and I'm bringing the cap rate up. And then all of a sudden you're like, oh, Matt's deal is actually more conservative and probably a better deal. So those are the things: the sponsor, the deal, and the market. And the most important out of all of those is the sponsor. That's the most important thing.
Good stuff.
Yeah, I agree. Yeah. And naturally, identifying the right sponsor is a challenge, right? So it's not like in the stock market where you have all the research analysts that come up with all their reports. They might still be wrong, but at least you have a lot of publicly available data. And you have audit firms that have audited the financials. And now here we are in the private space where you do not have all that information. Most of the deals are not audited. And so you have to dig in pretty deep. And the key really is, in my view, and please tell me if I'm wrong, that you really need to look at their past description of deals and how they have performed compared to those pro formas that they have prepared. And secondly, really talk to other passive investors in past deals, right? How have they performed? Is it just because the market helped them to bail them out, or have they done a good or great operational job? Or was it just because the cap rates compressed to ridiculously low levels?
Yeah, I mean, listen, we just sold a deal. We did incredibly well. We were hitting our business plan. So we were doing good, cash on cash distributions were great. But because the cap rates compressed, we sold it and I look like a genius, right? And I tell everybody, look, we did a good job. We bought a good place. We operated it well, but market forces are really what allowed us to get such a great return in such a short period of time. I think you're right there, Anton, and I think you're spot on in saying, being able to sort of take a look at what they've been saying they were going to do in the past, and if they've actually been able to do it is really important. And the most important thing for me is when I get a recommendation from another passive investor who's like, hey, I've invested in Anton deals before. He gets that 100% return. He's great. So stick with him. And the thing that's interesting for me beyond just performance, it is a part of performance, but it's not just the metrics, right? Is like communication, right? Some people really want good and frequent communication. Some people don't. So it depends what sort of investor you are. Me as a investor, I want updates. I invested in a deal that was a home run. We did great. I think we doubled our money in like 2 years. It was a small deal that I did with a friend. But I never got reporting. And we were like 9 months in on the deal, and I called him. I'm like, hey, can you send out like just something, just like anything, like, are we doing okay? Are we not? Like, just something, right? So that was frustrating for me. And there's been other people who just, the communication is not good. I patted myself on the back because we sold that deal, and did very well just last month. And one of my investors wrote me back and said, hey, Matt, like, awesome returns. Thank you. But also thank you for your whole communication, like throughout the whole deal. It was excellent. Like, I've invested in a lot of passive deals, and a lot of times we'll get sponsors who just don't communicate with us at all, or very seldomly. We got monthly reports from you, but they were just really happy with the level of communication. And that's how I feel as an investor. The deals that I tend to invest in a lot are, but yes, I want them to perform well. But if a deal's not performing well, but I'm getting that level of communication and it's being explained to me, I don't worry about it as much. And I even tend to lean more towards investing in someone's deal who maybe didn't perform quite as well, but the communication was better. Now, that's my style. That's not everybody else's style, but that's my style. I would want to get the more of communication. This is one of the things that I talk about in the book and in some articles that I've written. It's really about just making sure that you are aligned with your sponsor from sort of a value perspective beyond everything else, right? For me and my deals that I'm running, it's not just about the almighty dollar, which is important. And I'm not running a charity, and we are there to make a profit. But I also put the lives of the residents of the communities that we're investing in up there, and also the staff, right? So we try to make sure that all of our deals are a win-win. And I'm trying to reinvent property ownership as something that's an actual positive for communities. So I'm not going to be like reducing services and like reducing we do reduce expenses by being more efficient, but it's not like I'm taking services away and letting the property fall into a state of disrepair just to boost my NOI so I can get a better return. We go ahead and improve the property and make it better, make more people want to live there, create demand for it. And then we're able to bring the rents up moderately and increase our NOI going at it from that perspective.
Yeah, very valid point, right? Short term, you can squeeze everyone from tenants to employees, right? But if you have a long-term view, that is going to fire back, right? So if you act like a slumlord, ultimately your property will get into that stage very quickly, and your returns will come down. It's only a question of time. Very good point.
Thanks.
Yes. So, Matt, another question. Then, you highlight the importance of a sponsor. Just not wanting to necessarily dig into your whole process, but what are the kind of some of the touch points that how can an investor get familiar with the sponsor? Because in some ways, you're going to get the deal package, but how are you trying to find out more about someone other than what's in the slide deck and the PPM, the legal debt? Like, how do you get beyond that to find out more about that individual?
By talking with others. That's really where I've done. It's not like I'm running a background search on people, running like a criminal history check. Maybe that's something I could do, but I don't feel that I need to, because and maybe when I first started out, I should have. I don't know. maybe took some risks at the beginning that I was a little more just kind of loosey-goosey on. But since then, I've weeded out investments that I've invested in that haven't performed great, or that I don't like their communication style or their value approach. And I've grown my network. I have a pretty big network now, of people that I just know. Like I go to a lot of different conferences. I'm getting on the stage at a lot of different conferences at this point, and I just meet a lot of people, and I hear about things, and I hear about people, and I hear, about, there's rumors, there's gossip, but then there's talking with other passive investors, frankly, one-on-one about their experience with other investors. I know, John, let's say I know you invested with Anton. I'm probably going to have a conversation with you at some point, like a candid conversation about like, how did that go? And how was that for you? Now, I'm not going to take everything that you say like 100%. Like I'll take it all with a grain of salt. I realize different human beings interpret things in different ways. And, there could be, you might not like working with Anton again, but then I might meet 5 other people who all love working with Anton, so I take it all with a grain of salt, but I talk with people, and that is the best way, I think, to find out. The investor is always going to say good things about themselves. The investor also, I always follow up with it, but I've never fully really understood the idea of getting a reference. So, let's say there's a new sponsor I want to work with, John, I want to work with you. And I'm like, okay, you seem good. Can you give me 3 references I can call? Now, unless you're not very bright individual, you're probably going to send me the 3 best people that love you, right? You're not going to send me, oh, here's the people who, are going to be, you're going to send me the 3 that are your super fans, right? So I'm going to call them and they're going to be like, yeah, John's amazing. So like, I don't know how, like, I guess that's kind of good. And maybe you just don't have any super fans and you're just going to give me 3 names and they're going to not say great things about you. But, it's kind of hard to do it that way. But if I can find out from a source not coming from you, John, then that makes me feel a little better that data is not tainted.
Yeah. And just touching on your book real quick, you kind of go through an outline of what that process looks like. Because you've articulated it, but is that something that you cover there as well? Because some folks might have due diligence in their background, but just is there a roadmap available?
No, I don't know that there's not like a step A, do this, step B, do that. But I talk about, the book's written in a memoir style, right? So it's really like my story, starting as an actor, knowing nothing about real estate, all the way to where I am now. And I share with the reader 18 different keystone concepts that I learned along the way. And so some of those concepts are actually 3 of them you can download also on my website on the book page, right? But the first one is don't trade your time for money, which is, you can always generate money. You can't generate time, right? So then there's one about cash flow is king, right? Which talks about how cash flow is so important. So you can ride out those dips that you're going to have in market cycles. If you don't have to sell the real estate, you're not going to be forced to sell in a position where you're going to lose, right? If you can hold on to it. And then the other keystone concept that's in that free download is that you want to be financially free, and like the difference between being debt free and being financially free, right? You could have no debt, but still have to work. Or you could be in a position where you have responsible debt that's very manageable, and you have enough income coming that you don't have to like work your fingers to the bone in a 9-to-5 kind of job, right? So those are some of the keystone concepts. And then there's like terms that I share. There's 60 different real estate terms that I define in the book, but there's not really a how to find a sponsor. A, do this, B, do that, C, do this. But I do tell the stories of how I've met sponsors and the kinds of things that I've done. And then I tell a story about my first deal that I invested in and why it didn't do well. And that's when I learned how important a sponsor was. And here's the reason why the sponsor is important. And here's some things to look at when you're talking with the sponsor. What's the sponsor's involvement level in the deal? Is the sponsor just raising capital on the deal? Because that's actually a big no-no. So if they're breaking the rules with that, what other rules are they breaking? Things like that are, sort of anecdotal, not necessarily step by step.
Gotcha.
Yeah, very, very good point there. I would say when it comes to sponsors, really, as you said, talk to passive investors in past deals, and at some point you will identify a pattern about any individual, right? The more you talk to someone about the deal sponsor, the easier it is to create a pattern. And either you like that or you don't. And if you like it, then and you still like the deal and the market, then it's probably a good go. Right?
Yeah, I would agree. Yeah. I would agree. And then nothing's a guarantee, right? But if you're trying to mitigate your risk, right, in anything, and that's what you're trying to do. So if all signs sort of point to yes, then it's probably good, but it might not be.
Yeah, very good. So you mentioned cash flow is king. I would say in the current environment where we are in now, it's probably getting even more important with raising interest rates. So what is your strategy as a passive as well as a deal sponsor in the current environment?
Yeah, so when I look into my crystal ball, which is very hazy, by the way, I think the next 12 to 24 months are going to be, I don't think I'm saying anything earth-shattering here, right? But I think the next 12 to 24 months are going to be volatile, right? Like rates are probably going to continue up for 3 months, 6 months, maybe. And then we have to see what the economic data looks like. Then they'll probably flatten out at some point, right? And then they'll probably 12 to 24 months from now start to come down a little bit. I don't think we're going to, it'd be awesome if we are, because I would love it, but I don't think we're going to get back down to like 3% interest rate or sub 3. I mean, we locked in some deals. We locked in a deal at like 2.95 interest rate. That's insane. That's not I don't think that's happening again. Again, if it does happen, I'll be cheering it on. But I think, the guidance from the Fed is really that they're trying, I think, from what I'm understanding, and I'm not like an economist, right, is that they want to get back to a normal level, right? Normal Fed funds rate level. And really for the past 10 years, it hasn't been a normal. They were getting back to normal in 2018, and then in 2019 went way back down. And, it was on its way down. I wouldn't say that. And then COVID, and then, right? So I think that we're going to, we need to understand that interest rates are probably going to be between 5 to 7%, like just forever, right? But they start to seem, depending on the deal, depending on the sponsor and all of that, I think they're going to creep up above 7% if they haven't already, like depending on the deal that you're looking at, right? And all the different things that you guys are experts at, right? So I think that you guys, by the way, John and Anton, are going to be key to any deals that are going on. And Anton, you and I have had some conversations about this and looked at some deals and sized up some things kind of recently because, I was like, all right, well, where are things going and what kind of risk tolerance can we build in? What I would love to see on a deal as a passive investor is, hey, we've got a quote from our lender at 6.5 interest rate, so we've underwritten 7. And I always used to do that even back in the day, but I would do it by about 1/4 of a point. Now I'd love to see 1/2 point. I'd really like to see, because of the how quickly rates are going up, and they're supposed to continue up, right? But they can. So the market's built some of that in. Maybe they haven't, but all of a sudden the Fed does something that they didn't build in, and then changes. So I'd love to see some cushion there from a passive investor perspective, and also as a sponsor. I think that, the interesting thing is I don't love bridge debt and I don't love refinances. I've been involved in some of those deals, mainly more as a sponsor than from a passive side, but on both ends of the equation. And I think that now in this environment that we're in now, there's probably less risk. I was very worried about people who were doing those when interest rates were 3%, because it's like, well, okay, but 3 years from now, if the interest rate goes, like, can you handle that new debt service payment, and can you raise your NOI quickly enough? That's really the name of the game. If you can, you're good. But now it's like, look, if you're getting interest rate at 6 or 7%, and then you're doing, planning to do a refinance or something 3 years from now, and you're also assuming 7%, like, you're probably going to be, odds are you'll probably be okay. I mean, that's a historic norm. That 7% is like historically fine. Rates might even be lower. Again, I don't think they're going down to 3, but maybe they're 6. Maybe there's a pleasant surprise. Now, what I don't want to do is see someone who's doing a deal and they're like, hey, we're doing it. We're getting 7%, and we're sure that 3 years from now we're going to be at 4% interest rate, because I think that seems a bit aggressive. I don't know. I did a webinar a few weeks ago. Yeah. And it was about, I called it, it's the end of the world. And it was like, hey, it's the end of the world for real estate investing, but here are things that we need to look at. And I talked about 3 different things that we need to look at. And I wasn't giving advice, and I wasn't really making a prediction on where things are going. They're just the things that I was watching. The thing that I think is interesting about interest rates when you're looking at them is that in the past 5 tightening cycles, I think with one exception, the Fed has, once they stabilize rates and stop raising, there's a precipitous drop 9 months later. So I think some people are thinking that that's going to happen. Some people are thinking that's not going to happen. I was at something, I'll just say one last thing and then we'll go to the next question. I was at this event last week here in New York City. I wish I remember the name of the guy, because I thought he was brilliant. He was like a hedge fund guy, and he was speaking, and I talked with him about real estate afterwards. He does not believe, and this guy's got a big fund and a big podcast. He's very well known. He's the keynote at this thing, whatever. He does not think there's going to be a recession in 2023, and a lot of people do think there's going to be a recession. And he was explaining why. And he has a very well thought out, data-backed thesis on why there won't be a recession. And so if there is no recession and job growth remains good, there's no need for the Fed to really bring rates down below 5%. They don't need to stimulate the economy, and they do need to fight off inflation. So I don't know.
So what was his thesis? Why there won't be any recession?
It was, I wish I was as well versed and articulate as he was, Anton, because he spoke for about an hour. But the basics was that the economy is strong and the job market is strong. And he went into all kinds of stats that, again, are beyond me, and I'm not an economist, right? But he was citing this thing and that thing and what's going on here and what's going on there, and talking about what's going on in the emerging, and what's going on in China and India. And I mean, the whole macroeconomic global, and he doesn't see it. He's like, I don't see it at all. And we would need to see this precipitous drop in jobs and blah, 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 blah. I mean, it was a whole very interesting presentation. I wish I knew the name of his podcast, because I would tell you. It's something like Green Marbles or something along those lines. It's something like that. Very close to that, if not Green Marbles, something like that. And
okay, so you certainly will look it up.
Yeah, I don't know. He is an interesting guy.
Okay, very good. I think my take on this is, right, we just do not know, right? It's very hard to predict the future. It's very hard to predict whether we have growth, whether we have recession or not. But what I would say is like you also say, well, it would be great to get down to 3% interest rates for as a borrower.
Sure.
My response to that is be careful of what you wish for, right? Because if it drops to 3%, we talk about a pretty significant recession that is causing this, right? And particularly as a multifamily investor, we have to think of the tenant base, whether they actually can support the rents where we are now. We have had record rent growth. Can they still pay? And my prediction is if we have a pretty significant recession, we will suffer on the occupancy side as well as on the delinquency side, which is really, if I can pick between interest rates that are at a higher level and a solid economy and a solid tenant base, I'd rather have that than a recession and low interest rates.
I agree.
Yeah. Very good. So Matt, it was really a pleasure having you on with us. We already have mentioned your book, so maybe you just can give us your contact details, including your website, and how the listeners can get your book. And naturally, we'll put it into the comment section so that everyone has access to that information.
Yeah, thanks. That'd be great. If you go to Picheny.com, that's my website, and I'll just spell it real quick. It's PICHENY.com. You can download those free resources I was talking about. There's a link to the book. I have a monthly newsletter that I send out. There's a bunch of free resources. There's a whole big blog section with tons of educational articles on real estate. So go check out Picheny.com. Tons of free content and materials for everyone.
Okay, great. Thanks again, Matt, for being on with us today. Obviously, a very unique story, and we have known each other now for a while, and it's always great to see you and being successful in your ventures. So thanks again, Matt.
Well, thank you. It was an absolute pleasure to be on here with you two gentlemen today. I appreciate you having me on as a guest.
Thank you.
Thanks, Matt. We appreciate it.